What if the very actions intended to stabilize a region are the exact catalysts for your next supply chain crisis? For years, the global manufacturing sector has operated on the assumption that a strong military presence in the Middle East acts as a safeguard for the status quo. However, current market dynamics suggest a much more volatile reality. Recent industry research indicates that while increased naval deployments and military exercises aim for stability, their immediate impact on global commodity markets is paradoxically destabilizing. For the C-suite, this isn't just a matter of geopolitics. It is a direct threat to your bottom line, impacting everything from your energy overhead to the landed cost of every component in your facility. We are entering an era where geopolitical risk is no longer a peripheral concern. It is a core operational variable. As we navigate this shift, it is essential to understand how these military movements translate into market volatility. Leading analysts continue to report a profound oil market volatility amplification effect. The moment a carrier strike group enters a sensitive waterway, speculative trading shifts into high gear. We've seen this play out in recent months as Brent crude benchmarks experienced a 9% month-on-month increase, following reports of naval exercises in the Persian Gulf. In some weeks, prices have fluctuated by as much as 10%. For a high-volume manufacturer, a 10% swing in energy costs in 7 days isn't just an inconvenience. It's a disruption that can wipe out quarterly margins. This trend is further complicated by nations like China and India accelerating the buildup of their strategic reserves. This preemptive buying creates artificial demand spikes, further inflating spot prices and making it increasingly difficult for private sector leaders to forecast input costs with any degree of accuracy. The secondary, and perhaps more insidious effect, is the radical transformation of global logistics. When military activity increases in the Red Sea or near the Strait of Hormuz, the risk profile of these critical choke points changes overnight. Current market data shows that shipping costs for container routes between Asia and Europe via the Suez Canal have surged by an average of 150 to 200%. This is primarily driven by the necessity of rerouting vessels around the Cape of Good Hope, adding weeks to transit times. It isn't just about the fuel, it's about the risk. The cost of ensuring a very large crude carrier transiting these regions has increased by nearly 30% in a single quarter. For manufacturing leaders, this translates to heightened maritime insurance premiums and freight costs that must be absorbed or passed on to a consumer base already weary of inflation. Companies like Maersk and MSC have been forced to divert routes, creating a ripple effect of port congestion and inventory stockouts that can paralyze a lean production line. Beyond energy and freight, we are seeing a massive flight to safe haven assets, which further complicates the industrial financial landscape. In periods of heightened regional tension, gold futures have been seen to surge by over 4% in a single week, pushing past the 2,400 per ounce mark. While this might seem distant from the factory floor, it signals a broader systemic risk that influences the pricing of all industrial metals and hedging contracts. When gold rallies, it often precedes a tightening of credit and a shift in investor sentiment that can dampen global economic growth. The cumulative effect of these pressures, higher energy, extreme freight costs, and volatile raw materials, creates a persistent inflationary environment. This forces central banks to maintain a hawkish stance, potentially cooling demand for your finished products and tightening the margins on your operational expenditures. In this environment, the primary risk is no longer just a localized disruption, but an escalation to a broader regional conflict that could take a significant portion of global production offline. Sustained high commodity prices, if left unmanaged, will lead to reduced industrial output and a potential global recession. To counter this, elite manufacturing organizations are moving away from traditional reactive models and toward geopolitical risk-resilient strategies. This involves the urgent diversification of supply chains, moving beyond a reliance on single regions and embracing nearshoring or friendshoring to reduce exposure to these high-risk corridors. It also means moving beyond basic procurement and into sophisticated risk management. Investing in advanced analytics for real-time geopolitical assessment and implementing robust commodity hedging programs is no longer optional. It is the prerequisite for survival in a fragmented global market. Moreover, these disruptions are accelerating a strategic pivot toward energy independence. Heightened oil price volatility is driving forward-thinking VPs of operations to increase investments in renewable energy, battery storage, and energy-efficient technologies. By reducing a facility's reliance on fossil fuels, you aren't just meeting a sustainability target. You are creating a financial hedge against military developments 5,000 miles away. The goal is to decouple your production costs from the instability of the Persian Gulf. This transition, alongside technological advancements in AI-driven route optimization and real-time logistics tracking, represents the only viable path forward for maintaining profitability when the safe shipping lanes of yesterday become the conflict zones of tomorrow. My challenge to you this week is to move beyond the headlines and look at the hard data within your own organization. Sit down with your chief supply chain officer and your head of procurement to perform a stress test on your top 5 critical raw materials. Map out their journey from origin to your plant floor. If any of those materials pass through the Strait of Hormuz or the Suez Canal, you need to quantify the impact of a 200% freight increase and a 3-week delivery delay on your current production schedule. Once you have those numbers, you can begin the process of diversifying your sourcing or adjusting your hedging strategy before the next naval exercise triggers the next market spike. If you found this analysis valuable, please subscribe and join the conversation in the comments. How is your organization adjusting its hedging strategy in response to current geopolitical volatility? We'll be diving deeper into the specific technologies helping manufacturers